I mean, if you asked any portfolio manager a decade ago what asset actually goes up in value when the world gets closer to a nuclear crisis, they would all give you the exact same answer.
Right, they'd say gold without hesitation.
Exactly, gold. You buy gold when you're scared.
Yeah.
But over the last 4 days, basically from April 27th to today, May 1st, 2026, a mathematical ledger has sort of taken its place.
It really has. And watching it happen in real time is just wild.
It is. Tracking the sheer velocity of this shift over the last 96 hours has me feeling like I haven't slept in a month. I mean, 1 week in the digital asset space ages you about 5 years.
Oh, absolutely. The pace of structural change we're seeing right now is just, well, it's unprecedented. We are literally watching traditional macroeconomic theory collide head-on with decentralized protocols.
Welcome to Inside Bitcoin. For this deep dive, our mission is to cut through the absolute barrage of noise you've been bombarded with this week. We want to understand what's actually happening under the hood.
Yeah, because if you're looking at your portfolio and wondering why certain altcoins are bleeding out while Bitcoin breaks new ground, you really need to understand the mechanics at play.
Right, so we're going to break down the geopolitical pressures driving the recent $79,000 surge, the technical friction in the altcoin markets, and the reality of autonomous AI traders. Plus, this fascinating philosophical shift happening in how we define digital matter.
Which is a lot to cover, but it's crucial for understanding the current market structure.
It definitely is. And before we get into the weeds, I should note that this research comes from Mo and Moestradamos' research team.
It's honestly the perfect data set for us to examine today. A week like this, where you have extreme global stress overlapping with major protocol developments, it forces the market to reveal what it actually values.
So let's jump straight into that stress test, because on April 27th, we watched Bitcoin surge to $79,032.
Yep, a massive move.
And what caught my eye wasn't even just the price tag, it was the market fear index. For weeks, it had been buried in the red, just total market stagnation. But alongside this price action, it just snapped right back up to neutral.
And that sentiment shift is really the fingerprint of institutional capital stepping in. We saw a very clear return of ETS inflows, but I'd argue, more importantly, we saw the culmination of expectations around the Hong Kong ETF launches.
Right, the Asian institutional purchasing power. I want to pause on that Hong Kong element for a second, because for the first quarter of the year, it felt like all anyone talked about was Wall Street.
Yeah, BlackRock, Fidelity, the U.S. markets, that was the whole narrative.
Exactly. So for the listener who is just trying to balance their own portfolio, why does this specific Asian capital pool change the geometry of the market so drastically?
Well, it alters the market structure for two purely mechanical reasons. First, it introduces a completely different time zone of automated liquidity.
So the market doesn't just dry up when New York logs off.
Exactly. You no longer have these massive gaps in institutional bid support when the U.S. goes to sleep. But second, and honestly far more critical, is the actual nature of the capital itself.
What do you mean by the nature of the capital?
So the Asian institutional market has historically been much more aggressive in treating digital assets as a primary allocation rather than just some, fringe speculative tech play.
Right, they take it more seriously as a core holding.
They do. When you have sovereign wealth expectations and these massive regional asset managers preparing to buy, it creates a structural floor. The algorithms tracking these flows recognize that the recent dips weren't retail panic.
They were institutional accumulation zones.
Spot on. They were buying the dip.
Okay, that makes sense in a vacuum, but we aren't in a vacuum, right? And this is where I am really struggling to reconcile the data from this week.
The geopolitical side of things.
Exactly, because on that exact same day, April 27th, the global macro backdrop was terrifying. We had those nuclear talks between Washington and Tehran completely faltering.
Yeah, the tension there is immense right now.
The reports were saying Tehran proposed a phased deal, but Washington just held firm on its demands. So the Middle East is basically teetering on a nice edge.
It's a very fragile situation.
And usually, right, when the threat of a hot war escalates like that, traditional markets sweat bullets. Investors dump their risk assets and they flee to cash or treasury bonds.
That's the textbook traditional finance playbook.
So if Wall Street is treating Bitcoin as a risk asset, why didn't it dump? Is this the whole digital gold thesis finally playing out live under pressure? Or are the ETF algorithms just ignoring the news entirely?
That right there is the defining question of this entire market cycle. To understand why it didn't dump, you have to look at the historical correlation. For years, Bitcoin basically traded as what analysts call a high beta tech stock.
Meaning it just moves like a hyperactive version of the NASDAQ. Like if tech stocks go up 2%, Bitcoin goes up 5.
Yeah, and if tech stocks drop, Bitcoin just plummets. It was viewed as highly speculative. If you look back at, say, the onset of the COVID panic in March 2020, or the start of the Ukraine conflict in early 2022.
Oh man, the drawdowns were brutal.
Massive, immediate drawdowns. Investors treated it as risk-on, meaning it was literally the first thing they sold to raise cash when they got scared. But what we saw on April 27th is the clearest signal yet of a decoupling.
The institutional money just didn't sell off.
They didn't. The ETF algorithms kept buying.
So are the algorithms just blind to the nuclear news? Or are they actively programmed to view Bitcoin differently now?
It's the latter. The allocation mandates have fundamentally shifted. A significant portion of this capital now categorizes Bitcoin as a non-sovereign bearer asset.
Let's define that for a second, because that's a dense term. When you say bearer asset, how is holding a Bitcoin mechanically different for an institution than, say, holding a share of Apple or a U.S. Treasury bond?
It all comes down to counterparty risk. If you hold a share of Apple, you don't actually hold it. Your broker holds a digital IOU that's registered with a central clearinghouse.
Right, operating under U.S. jurisdiction.
Exactly. So if the system freezes or government decides to sanction that clearinghouse, your asset is entirely inaccessible. You don't control it.
You're relying on permission.
Right. A bearer asset, on the other hand, means whoever holds the physical or cryptographic keys outright owns the value. Gold is a physical bearer asset.
And Bitcoin is a digital one.
Yes. So when nuclear talks falter and global supply chains face disruption, the stability of sovereign governments comes into question. And by extension, the fiat currencies they print to fund these conflicts.
So institutions are realizing that in a scenario of extreme geopolitical fragility, a decentralized asset with a mathematically fixed supply is actually a hedge. It's protection against sovereign failure.
Precisely. They are buying the mathematical certainty.
Okay, so the narrative has really transitioned from a tech experiment to a geopolitical life raft. And I think that brings us perfectly to the projections we started seeing by May 1st.
The $500,000 models.
Yeah, it was everywhere. Because of this massive institutional floor, mainstream news outlets were heavily circulating predictive models pointing to Bitcoin hitting $500,000.
The bullish momentum was just undeniable by Wednesday.
It was. But if you were a retail investor holding a diverse basket of assets this week, you probably felt like you were living in an alternate reality.
Oh, the divergence was painful for a lot of people.
It's like Bitcoin is moving into this luxury institutional penthouse, while the broader altcoin market is stuck down in the basement dealing with burst plumbing.
That is a very accurate analogy. The divergence in price action between Bitcoin and the rest of the market this week was incredibly stark.
Just to put a specific number on it, on April 30th, Binance Coin BNB dropped 3.17%. And scanning the landscape, that drop wasn't tied to the Middle East news at all.
No, it was entirely internal.
Right, the BNB network was navigating a highly tense adjustment period ahead of an impending hard fork. So my question is, at what point does the market stop treating all digital assets as one big homogeneous bucket?
Well, I would argue April 30th was the day the market explicitly separated them. To understand why BNB dropped while Bitcoin surged, you really have to look at the mechanics of a hard fork.
It's not just a simple software patch, is it?
Not at all. A hard fork is an active, potentially network-splitting event. It requires every node operator to manually upgrade their software. The validators have to align on the new consensus rules.
And the community basically has to agree on the future state of the chain. It's essentially a governance crisis manufactured by code.
Exactly, because if even a fraction of the network disagrees or just fails to upgrade in time, you end up with two conflicting blockchains.
And markets absolutely despise uncertainty.
They hate it. During a hard fork, liquidity providers on decentralized exchanges will often pull their funds just to avoid the chaos of duplicated tokens or broken smart contracts.
Centralized exchanges might freeze withdrawals too, right?
Frequently, yes. So that 3.17% drop in BNB, that is the market actively pricing in that friction. Investors are realizing that altcoins are fundamentally technology platforms.
They require active management.
Yes, active management, developer intervention, continuous upgrades, and all of that means continuous execution risk.
While the $500,000 models for Bitcoin, they aren't based on it rolling out some fancy new software feature.
Not at all. Those models, which often rely on capturing a percentage of a global M2 money supply or a fraction of traditional gold's market cap, are based purely on monetary premium.
Right, Bitcoin is being rewarded by the market simply for existing.
Existing, remaining immutable, and never changing its core consensus. It doesn't have these hard forks that threaten its monetary policy.
So we have Wall Street algorithms treating Bitcoin as digital gold and human developers wrestling with the technical debt of altcoins. But humans and traditional Wall Street bots aren't the only ones driving this market anymore.
No, they certainly aren't. As of May 1st, we are seeing the rise of a completely new class of market participant.
Yeah, the evolution of artificial intelligence in this space really crossed a threshold this week. We're no longer just talking about AI as a passive analytical tool.
We're talking about AI as an autonomous agent.
Exactly. I was watching this 24/7 stream that went viral this week called Why Autonomous Digital Life. Have you seen this?
I have, yes. It's fascinating.
It's not just a chatbot spitting out text. It's a persistent entity living online, actively executing functions. And alongside these personality-driven agents, we are seeing autonomous predictive models gaining massive traction with retail traders.
The XRP prediction was the prime example of that this week.
Right. There was an AI model that correctly forecast a $1.54 price target for XRP, right after the asset successfully defended its $1.37 support level.
And that specific sequence of events, the defense of the support level, the AI prediction, and the subsequent price action, it forces us to reevaluate how liquidity is actually formed in a modern market.
I have to admit, I'm naturally skeptical here. How is this AI any different than a human technical analyst staring at a chart, seeing the $1.37 support hold, and just tweeting out a target?
Is it just day trading on steroids, essentially?
Yeah, exactly.
Well, it is fundamentally different because of the scope of data ingestion and the velocity of execution. A human analyst looks at a two-dimensional chart on a single exchange.
Right, maybe 2 or 3 screens if they're fancy.
Right. But an autonomous AI model is simultaneously scanning the order book depth across dozens of fragmented decentralized exchanges. It's calculating the velocity of social media sentiment in real time.
Oh, so it's pulling in qualitative data too.
Yes, and monitoring on-chain wallet movements of large holders, dynamically adjusting its predictive targets millisecond by millisecond. But the truly disruptive part isn't the analysis, it is the coordination.
Meaning, what happens when thousands of people actually listen to it?
Exactly. In traditional markets, a support level holds because a critical mass of human traders independently recognize the pattern and decide to place buy orders.
Right, it's organic, albeit kind of chaotic, human psychology.
But when an AI model with a massive retail following broadcasts a highly precise target, like $1.54, and thousands of algorithmic trading bots attached to retail accounts simultaneously execute trades based on that parameter,
the AI stops predicting the market.
yes, it begins coordinating the market.
So it becomes a self-fulfilling prophecy.
Right.
Are we trading against machines now? Because if the AI isn't just forecasting the weather, but it's creating the weather by directing the capital required to reach that target.
That fundamentally changes the geometry of trading. When the machines are the ones establishing the support levels and broadcasting the exit targets, human traders are forced into a purely reactionary position.
You aren't even trading the fundamentals of XRP anymore.
No, you are trading against the behavioral patterns and the execution loops of the AI agents managing the capital.
That is both fascinating and honestly slightly terrifying. But look, if AI agents are redefining what it means to be a participant in the market, there is a simultaneous movement happening on Bitcoin right now that is redefining the very concept of what a digital asset actually is.
Yes, and this is arguably the most profound philosophical shift in the history of cryptographic assets.
Looking at Moo's research on the DMT ecosystem, the narrative has completely evolved over the last few days of April.
It's moved way beyond typical crypto hype.
Exactly. The entire conversation has crystallized around this concept of the digital periodic table. Ecosystem researchers are pushing this thesis that the data inside a Bitcoin block is not just a receipt of financial transactions.
They're arguing that it is a literal, discoverable elemental structure.
Right. So to fully grasp digital matter theory, or DMT, we have to look at the prevailing paradigm it's trying to replace, don't we?
We do. For the last 10 years, really ever since the launch of Ethereum, the industry has operated on the philosophy of code is law.
Right, the whole idea of arbitrary smart contracts.
Yes. In the code is law paradigm, if you want to create a new digital asset, a developer sits down at a keyboard, writes a few lines of code, and unilaterally decrees that 1 billion tokens now exist.
Out of thin air.
Out of thin air. The developer decides the total supply, the inflation rate, the distribution mechanics, and all the metadata. The entire existence of that asset is subjective. It is an arbitrary invention.
It's essentially printing fiat currency, just doing it on a blockchain instead of at a central bank.
Precisely. It requires you to trust the human who invented it. DMT completely rejects that model. It introduces the concept of block as ledger, returning to the absolute minimalist physics of Bitcoin.
So under DMT, digital matter, which I know the ecosystem categorizes as nats and unats, is not arbitrarily invented by anyone.
No. It is structurally extracted from Bitcoin's history.
Let's break down those acronyms for the listener real quick. NAT stands for non-arbitrary token, and UNAT is a unique non-arbitrary token. But what makes them actually non-arbitrary in practice?
They are non-arbitrary because their parameters are dictated by natural phenomena within the Bitcoin network rather than a developer's whim.
Okay, natural phenomena like what?
Well, every single block added to the Bitcoin blockchain contains specific, immutable metadata fields. You have the nonce, which is the random number miner's guess to solve the cryptographic puzzle.
Right, the proof of work.
You also have the timestamp, recording the exact moment of creation. And crucially, you have the bits field, which mathematically represents the mining difficulty of the network at that specific moment in time.
So instead of a developer just typing the supply is 1 billion, the supply of a NAT is intrinsically tied to one of those raw data fields.
Exactly. For example, the issuance of a primary NAT might be directly derived from the bits field. As the mining difficulty of the Bitcoin network fluctuates based on global hash rate, the amount of that token that can be claimed dynamically changes. The rules governing the asset are permanently etched into the blockchain by the thermodynamic energy required to mine the block.
I really love the analogy of a digital prospector here, because unlike an Ethereum developer who basically plays God and snaps a token into existence with a keystroke, a DMT prospector is more like a geologist.
That's a great way to put it.
They are looking at the geological rock layers of Bitcoin's historical blocks, sifting through the thermodynamic data to find where the pressure and heat of proof of work naturally formed a digital diamond. You aren't creating it, you're discovering a nugget of gold that was mathematically already there.
That is the perfect way to visualize it. And this concept is being actualized through a protocol called bitmap.
And I should clarify for everyone listening, that is bitmap, as in bitmap Bitcoin block mapping, pronounced as 2 clear words.
Right. Bitmap, what it does is take that historical, non-arbitrary data of a Bitcoin block and translate it into spatial terrain.
Wait, spatial terrain, like a map. Literally. It maps the data fields into a dimensional landscape. The nonce might dictate the topography, while the timestamp might dictate the scale. It allows users to claim ownership over the specific spatial representation of a block.
So it's the foundation of the digital periodic table.
Yes, where blocks are the raw elements, and bitmap provides the physical space to interact with them.
But look, if these digital elements are discovered rather than invented, it completely destroys the traditional power dynamics of how tokens are distributed to the public.
It upends the entire model.
Which perfectly explains the massive ideological war we saw erupting in the Ordinal space between April 27th and the 30th. The community is aggressively pushing for what they call block drops over traditional airdrops.
And this is the practical application of ecosystem sovereignty. The traditional airdrop model is fundamentally broken because it relies entirely on centralized trust.
Walk me through the mechanics of why it's broken. Because on paper, an airdrop sounds great, right? A protocol rewards its early users by dropping free tokens into their wallets. Where's the friction there? The friction lies in the subjective metadata we discussed earlier. In a traditional airdrop, the founding team retains absolute control. They decide the snapshot date of who gets rewarded. They decide the allocation percentages.
And they can change the rules whenever they want.
Exactly. And almost inevitably, there is an insider allocation, a pre-mine, or some hidden vesting schedule where early venture capitalists and the developers themselves secure a disproportionate share of the supply before the public even gets access.
So the community just has to blindly trust that the centralized entity organizing the drop isn't manipulating the distribution for personal gain.
Which they often do.
It's the classic insider trading problem, disguised as a community reward.
Yeah.
So how does a block drop fundamentally solve that? Does tying the distribution to Bitcoin's block history actually make insider manipulation mathematically impossible?
In its purest implementation, yes. A block drop derives its provenance, its traits, and its eligibility directly from Bitcoin's proof-of-work physics.
Okay, give me an example of how that works.
Let's say a project initiates a block drop. The rules might dictate that anyone who executed a transaction in Bitcoin block height 800,000 is eligible to claim a specific digital element.
Okay.
And the amount they can claim is strictly proportional to the transaction fee they paid in that specific block.
Meaning the rules of the distribution are entirely retroactive and locked in stone. No developer can go back in time and alter the history of block 800,000 to sneak 1 million extra tokens into their own personal wallet.
Precisely. The founder loses their God mode privileges. The asset requires thermodynamic grounding.
That makes total sense. Like in the physical world, gold has value because it requires immense, verifiable physical energy and labor to extract it from the earth.
Right. You can't just forge a paper certificate saying you mined a ton of gold. The physical proof of work is the gold itself.
And a block drop applies that exact same thermodynamic grounding to the digital realm. It removes the need to trust a developer and replaces it with verifiable, non-arbitrary logic.
It's a complete checkmate against insider engineering. It takes the original promise of Bitcoin, which was trustless, decentralized money, and applies that exact same cryptographic rigor to the creation and distribution of every digital asset built on top of it.
It is ecosystem sovereignty in its truest form. It ensures that the digital matter being traded is as incorruptible as the ledger it lives on.
Absolutely.
Which honestly leaves us with a fascinating, slightly wild thought experiment to chew on as we wrap up this deep dive.
Let's hear it.
We started the week looking at massive institutional capital flowing into Bitcoin as a geopolitical safe haven. We then looked at autonomous AI agents like YUNA, who are developing the capacity to scan ledgers and execute trades entirely on their own.
Right, coordinating liquidity.
And we're ending the week with the realization that Bitcoin's blockchain is actively being mapped as a digital periodic table full of raw, non-arbitrary elements waiting to be discovered.
The convergence, it's incredible.
It is. So what happens to the global market structure when these two bleeding-edge trends intersect? What happens when these persistent autonomous AI agents learn to read the bitmap protocol?
Oh, wow. AI prospectors.
Exactly. When the digital prospector panning for non-arbitrary elements isn't a human clicking a mouse, but a machine capable of scanning a decade of block history in milliseconds. The scale and speed of digital discovery could change the entire landscape overnight. We are moving toward a reality where autonomous machines are mining and trading non-arbitrary digital physics entirely without human intervention.
That is a very real possibility, and it's something the market is entirely unprepared for.
If you want to continue the conversation and stay updated on Bitcoin price action and developments across the Bitcoin DMT ecosystem, check out the Discord link in the description or on the channel where Mo will be sharing ongoing research, insights, and updates. We'll see you next time on Inside Bitcoin.